In my view, the United States has been in a depression since 2007. And Japan has been in a depression since 1990, 1989, 1990. And that falls out of people not understanding the definition of a depression.
The current pandemic has drastically affected the financial markets, and the economy's future remains uncertain. Many economists and financial experts have different views on the situation, but one of the most outspoken is Jim Rickards. The American lawyer, economist, and investment banker firmly believes that the world is already in a depression, and his views have been gaining much traction in recent months. In his opinion, the current economic downturn is not just a short-term recession, but a long-term depression far deeper than what we've seen in the past. The United States and Japan are already in a depression, according to Jim Rickards. Rickards said that the United States has been in a depression since December 2007, when the economy first began to contract. Japan, he said, has been in a depression since 1990. It's quite apparent that these are not cyclical recessions that can be cured with a few months of stimulus. These are long-term structural problems that require painful reforms. Rickards has presented numerous convincing arguments to support his views about us being in a depression for a long time. His insights into the current economic situation have been invaluable for many investors, and it will be interesting to see what he has to say about the economy's future. Welcome back to our channel. In this video, Jim Rickards analyzes the effect of inflation on the economy and why he believes we are already in a depression. Please watch, like, and share this video. Also, drop your comments and thoughts below. Remember to like and subscribe to the channel for more related content similar to this. We begin with a short clip of Jim Rickards.
Why the stock market fell 22% in one day on October 19th, 1987? What's efficient about that? Inflation can come from two major vectors. One is the supply side, which is called cost push inflation. Costs go up and it gets pushed onto the market and the consumer. The other one is demand pull inflation, which is more psychological. It's driven by consumers. It's like, thinking of buying a new refrigerator. What's the rush? Oh, the price is going up. Well, I better go buy it now because if I wait 6 months, it's going to be 20% more. Now, when you look at the 70s, and I lived through it, that started out with supply shocks from the Arab oil embargo after the Arab-Israeli war in 1973. The price of oil quadrupled in 1974. Now it went from 3 to 12. Sounds small change compared to today, but it did go up by a factor of 4 in like 6 months. So that was a shock, and then that spread. But it actually, I remember early in the Ford administration, Gerald Ford now and Greenspan, they had these buttons that said WIN, which stood for Whip Inflation Now. It was a big PR campaign. Whip Inflation Now. We were in one of our worst recessions since World War II within 3 months. Stock market fell, I think, 30 or 40%. But the point is that proto-inflation turned into disinflation and recession, and the stock market crashed very quickly. But then it came back again thanks to our friends Arthur Burns and G. William Miller. G. William Miller, not well remembered, but probably the worst Fed chairman ever, although that's a major claim. And then they just pumped the money supply, and then it did take off on the demand side. So by the late 1970s, by then I'd actually started working for a living. I was at Citibank. I was the International Tax Council. They used to just give you a raise. You didn't even have to ask. They would say, "Hey, here's another $20,000." That's back when $20,000 was real money. And they would just give you a raise because they were afraid you were going to quit. They say, "Well, thank you," and then they give you another one a few months later. That was out of control, and that's when gold went from $35 to $800, a 2,100% increase, and then Volcker came in and crushed it all.
The global economy is in an unexpected tailspin. With the outbreak of the novel coronavirus, the world has been thrown into a state of uncertainty and turmoil. This has resulted in a dramatic decline in economic activity, leading some economists to suggest that we are already in a depression. The impact of the pandemic is being felt across all sectors of the economy, with businesses, households, and governments all struggling to cope with the current economic conditions. As a result, unemployment is rising, consumption is down, and economic growth is slowing. In order to help mitigate the adverse economic effects of the coronavirus crisis, governments worldwide are taking unprecedented steps to stimulate the economy. However, it remains to be seen whether these measures will be enough to prevent a full-blown depression. Listen to these carefully.
Now let's come to today. The inflation is coming from the supply side. It is coming from the supply chain breakdown. The pandemic made it worse. The war in Ukraine made it worse. That's not where it started. I was actually able to trace the roots of this. It started with the Trump tariffs on China in 2018. Now, I don't want to debate tariff policy. I actually happen to think that was a good idea. But what happened next was, so Trump throws the tariffs on like refrigerators and appliances and the solar modules. Well, it was applied to everybody, but China made most of it. So it was really aimed at China. So China shoots back. The two largest soybean producers in the world are the United States and Brazil. The biggest consumer is China. They need the protein. They were buying all their soybeans from the United States because we were buying all the stuff from them. Like, well, what can we buy from the United States to balance the deficit a little bit? They will buy the soybeans. And they did. Well, after Trump throws the tariffs on, China sends all the orders to Brazil. That's not a phone call. I mean, you got vessels at sea, you got port logistics, you got farmers who got to increase their capacity, you got to build new facilities in Brazil, and everyone involved. Nobody wants a 6-month deal. They want a 5-year deal or a 3-year deal at least. So all that soybean production is now expanding in Brazil. All the Brazilian soybeans, or not all of them, but a lot of them are going to China. And that's locked in. That's not coming back to the United States anytime soon. So what do the U.S. soybean growers do? Well, they looked around. Hey, the Netherlands, they need soybeans. So we start selling to the Netherlands. But think about what you're doing to transportation lanes. You're scrambling them. Yeah. You're saying, okay, you're not going out of Port of LA, you're going out of Houston or Port of Savannah or Port Elizabeth. And, Brazil, you get better fix things up in Rio or wherever they were coming out of, Buenos Aires maybe, to get those to China, and can you go through the Panama Canal or not? But this was a major reshuffling, and it was the beginning, and then the tariffs went back and forth. They escalated to $500 billion on each side. But this really broke the supply chain, and then the pandemic made it worse, and the war in Ukraine made it worse now.
As many Americans know, inflation is when the prices of goods and services go up. The main reason this happens is because the money supply has become too large compared to the amount of available goods, making each dollar worth less. The main driver of inflation in recent years has been the Fed's aggressive quantitative easing programs, which have led to a rapid expansion of the money supply. Now, however, it appears that inflation is coming from the supply side rather than the demand side. This is due to a number of factors, including the pandemic and the war in Ukraine. The pandemic has led to a decrease in the global supply of goods as factories have shut down and workers have been forced to stay home. This has caused prices for many goods to increase as demand outstrips supply. Similarly, the war in Ukraine has led to a decline in the supply of Ukrainian exports, such as wheat and coal. This has also contributed to higher prices for these commodities globally. Inflation from the supply side is often more difficult to control than inflation from the demand side. This is because it requires more than just printing more money. It also requires that businesses increase production in order to meet rising demand. In light of this, it seems likely that inflation will continue to rise in the months ahead even as economic activity remains sluggish. Listen to these carefully.
So we all know what a recession is, except Janet Yellen. 2 consecutive quarters of declining GDP is a recession. I know there's some bells and whistles, and the National Bureau of Economic Research has got to weigh in. I get that. But we had 2 consecutive quarters in the first half of 2022, declining GDP. There's your recession. Mild, brief, okay, but that qualifies. And Japan has had 8 recessions since 1990. A depression is different because people say, well, gee, if a recession is 2 consecutive quarters or 3 or 4 consecutive quarters of declining GDP, and a depression sounds worse, that must be 10 quarters of declining GDP. But that's not the definition. I use John Maynard Keynes' definition. He said it's a sustained period of below trend growth in which you neither collapse nor return to trend. So it's depressed growth. And the metric there is if you're capable as a society, and a mature, advanced industrial economy should be, of 3.5% growth or even 4% growth on occasion, and you're running at 2, that's a depression. Now, you don't have a technical recession, but that gap, that delta between 4 and 2, of course, it gets wider. This is lost wealth. We're now into like $7, $8, $9 trillion of lost wealth. average annual growth from 2009, when that last recession, well, whatever it was, recession was over, to 2019, just before the pandemic, so 11-year period, was 2.2%. But we should have been running 3.5, or maybe even higher at times. So I would say that's a depression because it's depressed growth under Keynes' definition. So we're still in that. And by the way, the Great Depression from 1929 to 1940 had two technical recessions. 1929 to 1932 was a technical recession. 1937, 1938 was a technical recession. But 1933 to 1936, the U.S. economy grew very well. The stock market rallied in the middle of the Great Depression, but that's my point. The problem was it rallied, but we were from such a low level that it's like you fell in a 100-foot hole and you climbed out 50 feet. Okay, nice going, but you still got 50 feet to go. And we know what he thinks. I always say forecasting the Fed is the easiest thing I do because they tell you what they're going to do. You just have to listen and believe them.
With the world in the midst of the largest economic crisis since the Great Depression, it is not surprising that many are asking if we are already in a depression. The answer is not unequivocally clear, as the definition of a recession or depression is often subjective and depends on various economic indicators. However, many economists and financial experts are now warning that the current situation is, in fact, an economic depression and that the economic outlook is likely to remain bleak for some time. Even though the official definition of a depression requires that the economy remains in a state of decline for 2 consecutive years, the current state of the global economy is clearly concerning, and it is worth considering what it means to be in a depression. Listen to these carefully.
So I don't need to recite it, but it's, he's going to 50 basis points in December, probably 50 basis points on February 1st, maybe 25 basis points on March 22nd. They're going to keep raising rates. So Powell is determined to get there. In my view, he's already past the terminal rate. We're at the terminal rate. And because recession's coming off the top, it's not going to be 2%, next month or anything, but it's coming off the top. So then this brings us to the Wall Street narrative, which is, okay, inflation's off the top, economy's slowing down, Powell's going to pivot, this is the pivot narrative, probably cut rates by, March or April. My version is that I understand Powell's path exactly. Wall Street's right that he's probably at or near the terminal rate already. Inflation is coming down already. It's going to come down some more. But where Wall Street is wrong is that this is going to be some kind of soft landing. This is going to be a very hard landing and a very severe recession for a lot of other reasons, including the fact that you're trying to destroy supply inflation with demand destruction. It'd be one thing if you were Volcker and the demand is out of control and you need to crush that, but you're trying to control this inflation with this toolkit. The Fed doesn't drill for oil, they don't run farms, they don't drive trucks, they don't do anything on the supply side. So how much demand do you have to destroy?
That's a good point.
To affect the supply side? So just to kind of wrap up here, but here's what's driving Powell. It's called the Volcker mistake. And if you go back to Volcker came in 1979. He immediately set out to destroy inflation, started raising rates, and he did. But we had a recession in 1980, a sharp one, that had nothing to do with Volcker monetary policy rates. Jimmy Carter put some stupid order on credit cards, and Americans put some cap on credit card interest, and Americans stopped using their credit cards. And it was like the pandemic. It was like you shut down the economy. Oh, gee, that was dumb. So they fixed it, and it went back up again. But in the middle of that, Volcker blinked. He lowered rates 7 percentage points. In the middle of that 1980 recession. But inflation wasn't dead, and it came roaring back, and then he had to take it up to 20 to finally kill.
Rickards' warnings of a pending economic calamity are based on a wealth of experience, facts, and data that he has carefully studied. While many experts disagree with his assessment, Rickards stands by his claim that the world is entering a period of economic decline that could have major ramifications for the global economy. With the economic data continuing to show signs of decline, it's worth examining the basis of Rickards' prediction and taking a closer look at what this could mean for the future. That's all for today. If you have any questions or contributions in regard to the topic being discussed in the video today, feel free to let us know in the comment section below. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates. Anticipate our next video update. Thanks for watching.